Right now, across boutiques in Manhattan, Miami, Los Angeles, and London, something shocking is happening. Dealers, or better described as flippers, who were sitting on $500,000 worth of Rolex inventory, are watching their life savings evaporate. In just 3 years, the Rolex Daytona 116500LN crashed from $45,000 to $32,000. That's a 29% bloodbath. The Submariner Date hemorrhaged 20% of its value while sitting in dealer safes. And the watches that were supposed to be retirement plans? They're now being dumped at fire sale prices on forums where sellers used to demand premiums. 720,000 watch listings flooded the secondary market in 18 months. Mountains of inventory that can't move. Dealers who borrowed against their collections now face margin calls. And it gets much worse, but we'll peel back the layers of what happened in this video. What the gray market actually is? Let's get clear on what we're really talking about here. The gray market isn't some shadowy underworld operation. It's the secondary market where Rolex watches get bought and sold outside official Rolex authorized dealer channels. These are legitimate businesses. Gray market dealers buy watches from private sellers, from other dealers, sometimes from authorized dealer customers who flip immediately. Then they resell at whatever price the market will bear. Authorized dealers sell at manufacturer suggested retail prices: $28,000 for a two-tone Daytona, $11,000 for a Submariner Date. Fixed, non-negotiable. Rolex controls that pricing with an iron fist. But the second that watch leaves the authorized dealer and changes hands, all bets are off. Supply and demand take over. And for nearly 3 years, demand was absolutely rabid. The gray market exists because Rolex produces roughly 1.24 million watches annually, but demand exceeds that by orders of magnitude. When you can't walk into an authorized dealer and buy a Submariner, you go gray. When you can't wait 18 months on a list that might never call your name, you pay the premium. The gray market became the only market for anyone who actually wanted to wear a Rolex sports watch. And its operators, the flippers, they feasted. Here's what we mean. The flipper economy. Flippers aren't watch enthusiasts. They are speculators who saw Rolex as an asset class. They cultivated relationships with authorized dealers by buying date-justs and jewelry nobody wanted just to get allocated one steel Daytona. Then they'd walk out of the boutique and immediately list it online for double retail. $10,000 profit for an hour of work. Some of these people were running actual businesses. They'd hit multiple authorized dealers in different cities, build purchase history at 5 locations simultaneously, get allocated 3 Submariners a year across their network. Flip them all. That's $45,000 in profit annually for maintaining relationships. The math worked beautifully when premiums held. Others treated it like sneaker culture. Camp outside boutiques for new releases. Cultivate inside connections. Trade allocation slots. Create group chats where they'd share intel on which authorized dealers just received shipments. An entire underground economy emerged around gaming the system. And for a while, everyone was making money. Authorized dealers moved inventory. Flippers extracted premiums. Gray dealers marked up 30%. The cycle seemed perpetual, but what caused this cycle of greed? Low interest rates made borrowing cheap. Why keep money in savings earning 0.5% when you could buy a Daytona, wait 6 months, and cash out with 15% gains? Flippers leveraged credit. Gray dealers secured business loans at 3% interest to buy inventory they knew would appreciate. The cost of capital was essentially free, so speculation became rational behavior. But then came the free money. Stimulus money flooded the economy in 2020 and 2021. $1,200 checks, $600 checks, enhanced unemployment. People who suddenly had disposable cash started chasing status symbols. Rolex searches on Google spiked 89% in 2021. Authorized dealer foot traffic tripled. Every suburban dad with a stimulus check wanted a Submariner. That demand surge hit a market with fixed supply. Premiums exploded. Speaking of explosions, crypto gains created a new class of overnight millionaires. 23-year-olds who bought Ethereum at $80 watched it hit $4,000. They had money to burn and zero financial sophistication. Rolex became the ultimate flex. Buying a Daytona at double retail felt cheap compared to gains they'd made on Dogecoin. These buyers didn't care about value retention, they cared about status. And they paid whatever the market demanded, and social media hype amplified everything too. Instagram watch accounts with 300,000 followers posting wrist shots of steel Daytonas, YouTube videos titled, "I finally got the call," TikTok flippers showing their margins. Every post reinforced the same narrative. Rolex is unobtainable, Rolex is appreciating, Rolex is investment grade. The watches became a cultural obsession. Aspirational buyers who never considered luxury watches suddenly couldn't imagine life without one. By late 2021, the frenzy reached fever pitch. Authorized dealer waitlists stretched 3 years for popular models. Gray market Submariners traded at $12,000 over retail. The Tiffany Blue Oyster Perpetual, with a retail price of $5,500, was selling for $67,000. That's 11 times retail, for a time-only watch with no complications. The market had completely detached from reality. Something had to be done, and fast, but the question was, what? What did Rolex do? Rolex watched all of this unfold and made a calculated decision: do nothing. They didn't ramp production. They didn't flood the market. They maintained their manufacturing pace of 1.2 million units annually, same as always. Their official position? We do not control secondary market prices. Authorized dealers independently manage allocation. But behind the scenes, Rolex was adjusting strategy. They tightened distribution rules. They required authorized dealers to verify buyers weren't immediate flippers by checking purchase history and intentions. They encouraged dealers to build long-term customer relationships rather than transactional sales. Some boutiques started requiring jewelry purchases before allocating sports models. Others instituted informal spending thresholds, where you needed $50,000 in purchase history to be considered for a Daytona. In 2023, Rolex quietly made their boldest move yet. They acquired Bucherer, the world's largest watch retailer and their biggest retail partner. Overnight, Rolex controlled both manufacturing and a massive chunk of retail distribution. They could now directly influence how watches reached customers. They expanded their certified pre-owned program, creating an official secondary market they controlled. They essentially told gray dealers, "We're coming for your territory." Rolex had declared war, and it was brutal. The bubble begins to burst. The peak happened in March 2022. That month, the Rolex Market Index tracking the top 30 models hit its all-time high. Then reality started creeping back in. Interest rates began climbing. The Federal Reserve raised rates 7 times in 2022, taking them from near zero to over 4%. Suddenly, the cost of capital wasn't free anymore. Flippers who'd borrowed to buy inventory faced higher interest payments. Gray dealers who'd leveraged their businesses saw financing costs triple. The math that made speculation profitable began breaking down. Crypto collapsed. Bitcoin plunged from $69,000 to $16,000. Ethereum cratered 75%. All those overnight millionaires watched their portfolios evaporate. The buyers with money to burn suddenly had no money. Demand from crypto bros dried up completely. One gray dealer reported his sales to crypto buyers dropped 95% between 2022 and 2023. Inflation hit hard. When gas costs $6 a gallon and groceries eat half your paycheck, luxury watches become less compelling. Even well-off buyers tightened spending. The psychological shift was dramatic. In 2021, buying a Rolex at premium felt like partying. In 2023, it felt irresponsible. Consumer sentiment flipped, and social media moved on. The Instagram flex culture that drove hype started favoring other status symbols. Watches gave way to fashion, travel experiences, and cars. The cultural moment that made Rolex watches viral content passed. Influencers who built followings on watch content pivoted to other niches. The hype machine that had amplified demand simply stopped feeding it. By late 2023, cracks appeared everywhere. Listings on Chrono24 and eBay surged. Dealers who used to sell inventory within days were sitting on watches for months. Prices started dropping, not crashing yet, but trending downward. 10% off peak, then 15, then 20. Flippers who'd paid premiums at peak now faced losses. The ones who'd borrowed, they were underwater. But the real pain? That was still coming, because 2024 and 2025 would reveal just how badly people had miscalculated what Rolex watches were actually worth when the hype evaporated. And that's when the dealers really started breaking down. The numbers don't lie. We're not talking about an overnight crash here. This isn't the stock market where everything tanks in a day and recovery begins the next morning. This is a gradual, grinding erosion that's been happening for 3 years straight, and the data tells a brutal story. According to the Watch Chart's Rolex Market Index, which tracks 30 of the most popular models, secondary market values are down 30 to 40% from their 2022 peaks. Let that sink in. If you bought a Submariner Date at the height of the frenzy for $15,000, it's worth $9,000 today. That's a $6,000 loss on a watch you probably thought was appreciating. The Daytona 16500LN, the peak price was $45,000. Today, it's trading around $32,000. Gone. $13,000 vanished. And remember, retail on that watch is $28,000. So even at $32,000, the premium is now just $4,000. Compare that to the $15,000 to $20,000 premiums dealers were commanding in 2021. The margins that made flipping profitable have completely evaporated. Many models now trade at, near, or even below retail. The two-tone Submariner that retails for $15,000, you can buy pre-owned for $13,000. The Yachtmaster in steel and gold, below retail in most markets. The Sky Dweller in precious metals, take your pick, plenty available, all under retail. These aren't fire sales yet, but they're certainly not the investment-grade assets everyone believed they were buying. Here's where it gets truly bizarre. While secondary market prices have been falling since 2022, Rolex retail prices have been rising. The retail-resale divergence. In January 2025, Rolex implemented price increases ranging from 1% on steel models to 8% on precious metal pieces. A gold day date that retailed for $42,000 in 2024 now costs $46,000. That's a $4,000 overnight hike. Why does this matter? Because it creates a massive gap. New watches cost more, used watches cost less. That's the opposite of how the market worked during the boom. When gray market Submariners sold for $12,000 over retail, buying new made no sense. Now, if you can get allocated, buying new is actually a smart financial move. Rising gold prices drove much of the retail increase. Gold went from $2,000 per ounce in 2020 to over $2,600 by early 2025. Rolex had to adjust pricing on gold models to maintain margins. Makes sense. But here's the problem. Gold Rolex watches in the secondary market aren't appreciating proportionally. A gold Daytona might retail for more, but pre-owned versions are still trading at 2022 prices or lower. Buyers aren't willing to pay retail premiums anymore. This divergence is crushing gray dealers. They bought inventory at old retail prices, expecting to sell at traditional margins. But now, retail went up and resale went down. They're caught in a vice. A dealer who bought a gold GMT Master 2 at $42,000 can't move it at $45,000 because new buyers can get the updated model at authorized dealers for $46,000. The 10% margin gray dealers relied on? Gone. We'll elaborate more on this in this next part. Reduced margins, bloated inventory, slower sales. Let's talk about what it actually means to run a gray market business right now. You've got watches you bought at peak prices. Maybe you paid $14,000 for a Submariner Date when that was below market value. Now that same watch is worth $9,000. You're underwater by $5,000 per unit, and you've got 12 of them in your safe. $60,000 in losses. Just sitting there, mocking you. And you can't liquidate because the market is flooded. Every other dealer is in the same position, trying to offload inventory before prices drop further. You lower your ask, someone else undercuts you, you drop yours again. Now you're in a race to the bottom where nobody wins except the buyers. The margins that used to make this business profitable have evaporated completely. In 2021, a gray dealer could buy a GMT Master 2 from a private seller for $13,000 and flip it to an end buyer for $16,000. $3,000 profit for minimal work. Today, that GMT Master 2 trades at $11,000. You buy at $10,000, sell at $11,000, net $1,000. And that's before accounting for time, storage, insurance, and opportunity cost. $1,000 margins don't sustain businesses with overhead. Gray dealers need volume now to survive. But volume requires inventory, and inventory requires capital, and capital is expensive because interest rates are high. The entire business model that worked during boom times is fundamentally broken. Sales velocity has collapsed. A watch that used to sell within 3 days now sits for 3 months. Carrying costs accumulate, insurance, storage, financing interest. A dealer who financed his inventory at 6% annual interest is paying $500 per month per watch. That Submariner sitting in your safe for 90 days? That's $1,500 in interest alone. Suddenly your $1,000 margin on the sale is negative $500 after accounting for carrying costs. Some gray dealers report business down 40% year over year. Others admit it's worse, 50, 60% declines. These aren't businesses pivoting to new markets. These are operations going under. Chrono24 announced layoffs of 110 people, nearly a quarter of their workforce. That's a clear signal. The marketplace facilitating gray market sales can't sustain current staff because volume has died. Can you guess what happened next? The exodus of speculators. The crypto bros who treated Rolex like another asset class? Long gone. They rode the wave up, cashed out early enough to make gains or take manageable losses, and moved on to other speculative plays. They were never watch people. They were opportunists. When the opportunity evaporated, they did too. Sneaker-style flippers suffered a similar fate. These were people who applied supreme drop strategies to Rolex allocation. They'd camp outside authorized dealers for new releases, run bots on online drops, build networks of allocators. And for 18 months, it worked. But when premiums disappeared, the juice wasn't worth the squeeze anymore. They went back to sneakers, trading cards, NFTs, whatever the next hype market was. Rolex was a chapter. They closed the book. What's left is a healthier market, according to industry analysts. By healthy, they mean fewer speculators and more genuine collectors. People buying Rolex because they love watches, not because they expect 10% annual returns. In theory, that's good for the brand and the hobby. In practice, it means transaction volume has crashed, but not all of it did. Rare models hold, everyday models collapse. If you're a flipper who specializes in rare discontinued pieces, you're probably doing okay. The Hulk, the Pepsi GMT on Jubilee, certain Daytona references, these still command premiums. Not what they did at peak, but stable. Collectors who want these watches have no choice but to pay gray market prices because authorized dealers don't have them. But if your business model was flipping current production steel sports models, you're getting destroyed. These watches are now available at authorized dealers with reasonable wait times. 3 weeks for an Air King, 2 months for an Explorer. Even the Submariner Date, which used to require years of waiting, can be had in 6 months if you have purchase history. Why would anyone pay you a premium when they can just be patient and buy retail? They wouldn't. They don't. And that's why flippers focused on these models are sitting on inventory that depreciates monthly, while they desperately try to cultivate new relationships with authorized dealers to get allocated actually rare pieces. The everyday steel Submariners, GMT Master 2s, and Explorers that were supposed to be reliable flips are now anchors, dead money. And flippers who thought they could treat Rolex like a savings account learned a painful lesson. Watches are not liquid assets during bear markets. Forced sales and community complaints. The forums tell the real story. You read posts online where flippers are venting and losing their minds. Well, some borrowed against their Rolex inventory when watches were appreciating. So, we understand why they are losing their minds. A lender will loan 50% of asset value. When a Daytona was worth $45,000, they loaned $22,000 against it. Now, that watch is worth $32,000. The lender demands the borrower put up more collateral or pay down the loan. These dealers don't have liquid capital. They're forced to liquidate at whatever price the market offers. Forced liquidation is death in any bear market. You lose negotiating power. Buyers know you're desperate. They lowball. You accept because you have no choice. Those lowball sales set new market comps. Other sellers see those comps and lower their asks. Prices decline faster. It's a death spiral. The complaints about taking losses dominate conversations. But here's the thing. Complaints don't change market conditions. You can be angry that your Submariner lost 30% of its value. Your anger doesn't create buyers. It doesn't restore premiums. The market doesn't care about your feelings or your basis cost. It only cares about current supply and demand. And right now, supply far exceeds demand. Every metric confirms it. Inventory levels at gray dealers are 3 times what they were in 2021. Listings on Chrono24 surged from 200,000 in 2021 to over 360,000 by mid-2025. That's an 80% increase in available watches. Meanwhile, transaction volume dropped 40%. More inventory, fewer buyers. There's only one mathematical outcome: lower prices. And for flippers who bet their livelihoods on Rolex always appreciating, the breakdown is complete. They're not just losing money, they're losing the identity they built around being watch investors. They're learning the hard way that Rolex watches are luxury goods, not securities. And luxury goods go down in value when hype fades. That's the reality of 2025. The flippers are broken, and the market isn't coming back to save them. But while individual flippers suffer, the broader Rolex market is undergoing a transformation that might actually strengthen the brand long-term. Because when you strip away the speculators and the hype chasers, what remains reveals the true value proposition. And that's where things get fascinating. Overall, market health. Correction versus catastrophe. Is what is happening healthy or disastrous? Depends entirely on your perspective. If you're a flipper who leveraged yourself during the boom, this is a catastrophe. Your business model is dead. Your inventory is underwater. Your income stream dried up. For you, this is a devastating wipeout that might take years to recover from. But if you're Rolex corporate, this is arguably ideal. The brand's long-term health doesn't depend on gray market flippers making money. It depends on desirability, craftsmanship reputation, and aspirational appeal. And by every measure that actually matters to Rolex, the brand is stronger than ever. Annual sales hit record highs in 2023, despite the market correction. Rolex produced 1.24 million watches and sold every single one at authorized dealers. Think about that. While gray market prices were collapsing, Rolex itself was moving more inventory at full retail than any prior year. The weakness is entirely in the secondary market. The primary market remains bulletproof. Brand desirability hasn't declined. People still dream of owning a Rolex. The waiting lists at authorized dealers are shorter, but they haven't disappeared. Walk into a boutique and ask for a Daytona. You're not getting one today, maybe not this year. The watches are still exclusive. The difference is, the exclusivity now creates retail demand, rather than gray market speculation. That's better for Rolex. The speculative bubble inflating, that was actually dangerous for Rolex. When a Submariner traded at triple retail, it priced out the aspirational middle-class buyers who make up the core customer base. A 30-year-old professional saving for his first luxury watch can't afford $16,000. He can afford $11,000. By keeping gray market premiums sky high, flippers were inadvertently destroying Rolex's customer pipeline. Now those buyers can re-enter the market, whether through authorized dealers with shorter waits or gray markets at near retail prices. Accessibility has improved dramatically. That's good for long-term brand health. You want your entry-level buyers to have a path to ownership. Otherwise, you lose an entire generation of potential customers. So, who benefits from the correction? Genuine collectors are thrilled. For 3 years, they were priced out of watches they actually wanted to wear. They watched speculators drive up prices on pieces they'd been admiring for decades. Now, opportunity. An Explorer. 36 that was unreasonably priced at £10,000 is available for $6,000. That's closer to rational pricing for a time-only steel watch. True enthusiasts who buy watches for craftsmanship and heritage rather than investment potential finally have leverage. They can negotiate with gray dealers who are desperate for sales. They can wait for authorized dealer allocations, knowing that gray market premiums no longer create urgency. The power dynamic shifted from sellers to buyers, and collectors love it. Authorized dealers benefit enormously. For years, they watched flippers extract value from their allocation. An authorized dealer sells a Daytona at retail for $28,000. Flipper walks out and immediately sells for $45,000. That $17,000 in profit went to someone who contributed nothing to the brand ecosystem. Pure rent-seeking behavior. Now that flipping is unprofitable, authorized dealers can allocate to customers who will actually wear the watches and become long-term clients, build real relationships, create loyalty. The business becomes sustainable rather than transactional. Rolex specifically encouraged this shift by telling dealers to be less afraid of selling to flippers. Translation: focus on genuine customers. Accept that some flipping will happen, but don't let speculators dominate your allocation. Rolex Corporate wins across every dimension. They control more of the retail chain after acquiring Bucherer. They've launched a certified pre-owned program that lets them compete in the secondary market they previously ignored. They maintained production discipline, avoiding the temptation to flood the market and dilute brand value. And most importantly, they weathered a speculative bubble without taking reputational damage. The watches didn't fail. The speculators did. And the big question is, what happens now? Conclusion: what comes next? The breakdown of Rolex flippers in 2025 tells a bigger story than just watch market corrections. It's a case study in what happens when speculative mania meets reality. When people forget that luxury goods are consumption, not investment. When social media hype creates bubbles that economics inevitably pops. For 3 years, flippers convinced themselves they'd found an infinite money glitch. Buy Rolex, wait briefly, sell for automatic gains. It worked until it didn't. The economic conditions that created the boom were temporary. When those conditions reversed, the foundation crumbled. The dealers sitting on underwater inventory, the flippers panic selling at losses, the gray market businesses collapsing, these are not victims. They're participants in speculation who bet wrong. They treated functional objects as financial instruments and learned that markets don't always cooperate. But here's the fascinating part. Rolex itself is fine. Better than fine, actually. The brand moved record volume in 2023. Retail sell-through remains nearly perfect. Authorized dealers serve genuine customers instead of flippers. The correction removed speculation while preserving core brand strength. Wealthy collectors never stopped buying. They're accumulating discontinued rare pieces at slightly better prices. Aspirational buyers are returning as accessibility improves. Enthusiasts are thrilled to finally have leverage in negotiations. The customer base is healthier now than during peak speculation. The watches themselves didn't change. A Submariner is still the same tool watch it's always been. Robust, reliable, beautiful. The speculative premium that was briefly attached to it was always absurd. Now prices reflect reality. A $10,000 steel watch with no complications should not trade at $30,000. The market correcting that mispricing is appropriate, not tragic. For the flippers breaking down, crying about losses, venting on forums, this is tuition. You paid for an expensive education in market dynamics. The lesson: scarcity-driven premiums are fragile. Economic conditions change. Hype fades. Leverage amplifies losses just as powerfully as it amplifies gains. Some of you will recover. You'll eat the losses, learn from mistakes, and move on. Others leverage too heavily and face bankruptcy. That's the risk you accepted when you borrowed to buy luxury goods, hoping they'd appreciate. Risk materialized. Consequences followed. The gray market will persist. It always will. There's genuine value in immediate availability, authentication services, and access to discontinued pieces. The dealers who survive will be the ones who love watches, serve collectors, and run sustainable businesses rather than chasing quick flips. Rolex will continue making million-plus watches annually. Demand will continue exceeding supply for certain models. That gap is the gray market. But the gap will be smaller, the speculation less frenzied, the buyers more genuine. Will prices ever return to 2022 peaks? For truly rare discontinued pieces, probably. For current production steel sports models, unlikely. The psychological shift from investment to luxury goods is probably permanent. This generation learned that Rolex doesn't always go up. That lesson sticks. And maybe that's exactly what the market needed. A painful, expensive lesson that resets expectations. Luxury watches are not stocks. They don't have earnings. They don't pay dividends. They're metal and mechanics that tell time and signal status. Beautiful, functional, historically significant, but not investment vehicles. The flippers who understood this survived. The ones who forgot paid the price. And the market, as it always does, moved on. If you were thinking about flipping Rolex watches, this story should give you pause. The easy money era is over. The people who made fortunes during the boom were lucky with timing, not smart about fundamentals. Getting into gray market dealing now means competing with established dealers who have lower cost basis, better relationships, and more experience. If you're a collector, this is your moment. Prices are reasonable. Availability is improving. Dealers are motivated. Buy what you love. Wear it. Enjoy it. Pass it down. That's what Rolex watches were always meant for. The speculative bubble burst. The market corrected. The flippers broke down. But the brand endures. And in 20 years, people will look back at 2020 to 2022 as the era when Rolex briefly became a meme stock, a historical footnote, an aberration. There are still more aberrations in the luxury world. To keep up with all of them, like this video and subscribe to this channel for more.